We've all been conditioned to believe that building millions of dollars requires some kind of genius-level intellect, or maybe an enormous salary, or predicting the next massive tech startup before anyone else does. But what if I told you that the harder you work at investing, the less money you actually make? What if the literal secret to your financial independence is learning how to do absolutely nothing at all?
91%. That's right. That is the exact amount of a multi-million-dollar retirement portfolio that can be built completely by the market, without you doing a single piece of the actual work.
Section 1. The Index Fund Advantage. Okay, let's dive into this, starting with the actual mechanics of the simplest, most beautifully boring financial tool ever created. So an index fund is basically a single purchase that gives you a proportional stake in every company in a market index, all at the exact same time. And this brilliantly illustrates how your only real job as an investor is to simply own the market, rather than trying to stress out and guess what it's going to do tomorrow.
Think about it. When you buy a simple S&P 500 index fund, you instantly own a piece of Apple, Microsoft, Amazon, Google. You hold a direct stake in the 500 largest, most profitable companies in America, literally in one single transaction. And honestly, that is the entire active requirement of this whole strategy.
Section 2. Math that defeats experts. We are now looking at the exact S&P Global SPIVA data that makes the highly paid, heavily marketed financial industry deeply uncomfortable. When we examine actively managed funds, the ones run by Wall Street professionals whose entire job is to try and pick winning stocks, 92% of them actually underperform a simple S&P 500 index fund over 15 years. 92%. These experts, with all their advanced algorithms and endless resources, actually lose to a fund that simply owns everything and does absolutely nothing. Let's look at the math. If you invest just $300 a month into an S&P 500 index fund at its historical 10% average annual return, the compound growth just completely takes over. At 10 years, you have $61,000, but you only contributed $36,000. At 20 years, you have $206,000, and you contributed just $72,000. At 30 years, you have $592,000, with a total contribution of $108,000. And at 40 years, you have a staggering $1.6 million, having contributed just $144,000. Now, what's really interesting about this slide is the breakdown right at that 40-year mark. The market contributed over $1.4 million. You contributed just $144,000. That is a 10-to-1 ratio. The market literally did 91% of the heavy lifting. This means any ordinary person starting right now today can absolutely let the global economy build their wealth for them. Section 3. The wealth-destroying fee. So the crucial point here is that the single most important yet widely ignored number in long-term investing isn't actually your return, it's the fee. A typical actively managed fund is going to charge you a 1% annual fee. Now, I know that sounds pretty harmless, right? Just 1%. But big institutions like Vanguard, Fidelity, and iShares, they offer simple index funds with a microscopic 0.03% expense ratio. Let me put that into perspective for you. On a $100,000 portfolio, that seemingly tiny 1% fee over 30 years, it costs you an incredible $369,000 in lost compound growth. That is quite literally life-changing wealth, just completely erased from your family's future. But check this out. The lowest cost index funds charge 0.03% annually. On that exact same $100,000 portfolio, that comes out to exactly $30 a year. $30. Section 4. The 5-step playbook. We're shifting gears to actionable implementation right now, bridging the gap between all this financial theory and immediate personal action. Step 1. Open a tax-advantaged account like a Roth IRA, 401k, or ISA. Why? Because this completely protects your compounding growth from being drained away by taxes. Step 2. Choose a total market or S&P 500 index fund with an expense ratio below 0.10%. This guarantees you actually get to keep the money your money makes. Step 3. Set up dollar cost averaging with automatic monthly contributions before that money even reaches your spending account. This brilliant little trick removes human emotion and willpower from the equation entirely. Step 4. Reinvest all your dividends automatically. This just accelerates that compounding snowball without requiring a single extra cent from your pocket.
And step 5, do not check the account more than once a quarter. Seriously, this simple boundary prevents you from panic reacting to perfectly normal daily market noise. Setup time, one afternoon. The payoff, decades of compound growth.
Section 5, Surviving Market Crashes. Let's move to and see how this builds when we confront the ultimate psychological challenge of investing. See, most people fail at investing simply because they panic and sell during downturns. Since 1950, the S&P 500 has dropped 20% or more 8 separate times. In 2008, the market dropped 57% from peak to trough. In 2020, it dropped 34% in exactly 33 days. But guess what? Every single time it fully recovered. Every single time it reached new all-time highs. Market crashes aren't actually the threat to this strategy. Selling during them is. The real-world evidence for this strategy is actually kind of funny. Internal research from Fidelity once found that their absolute best-performing accounts shared one striking trait. They were either totally forgotten by their owners or owned by deceased investors. I mean, the best investor behavior, statistically speaking, is to invest your money and just completely forget it exists. Because of this math, actual index fund millionaires are rarely Wall Street insiders in fancy suits. They're teachers, they're nurses, postal workers, civil servants. This strategy doesn't require extraordinary income at all. It just requires ordinary income applied with extraordinary patience. Section 6, the final mindset shift. We have finally reached the philosophical perspective that completely reframes the entire concept of building wealth in our modern financial system. Wealth is not a reward for intelligence. It is the mathematical reward for disciplined boredom. True financial freedom is buying your own time back from a system designed to keep you working. The sole difference between those who build generational wealth and those who do not is the willingness to let capital sit quietly in the dark. Your future independence is simply waiting for you to begin. Who do you know that still thinks investing is only for the wealthy? Share this explainer with them right now. And if you're ready to keep learning, the next explainer is right there on your screen.